market veteran with both global and domestic experience. Sandeep Bharadwaj, CEO and Head Equity Strategy at Tar Capital and Security. Sandeep, great to have you with us. Let me start with something on the global concerns. Right now, everyone's talking about earnings downgrades. We've heard what's happening in terms of the rescue package for the auto sector, compounded with the fact that the G20 seems to be a lame duck session. How would you place all this coming in?
Hi, good morning. There's too many questions in one go, so I'll try and answer it one by one. First, we need to focus on the epicenter of this problem, that is the US. I'll try and talk about the US a bit and then take it from there to G20 and then boil it down to India and China. Would that be okay?
Yeah, sure.
So the US, the thing is that we may actually see the October lows coming into the very near future. In the US, the excesses of the last 20 years will not be wiped out in a very short duration. I think it may take a few years before these excesses get wiped out. The US recession will be a prolonged and a deep recession one. The $2 trillion package which the Fed has already started implementing in terms of the bailout plans, I mean, our view is that they will not be able to prevent the cyclicality of the economic downturn, no matter how much amount of money that they end up printing. Now, the question is, if it had been any other country which would have printed the money the way US has done, it would have easily turned into a banana republic by now. But the fact is, I mean, we don't have any alternative to the dollar. So US can get away with whatever they want. So, and the G20 meet, which the market is talking about a lot, I think, as you mentioned, it will be a lame duck situation anyways, primarily because of two reasons. The first one is, the G20 camp is divided into three groups. The first one being the Anglo-Saxon camp, second one is the continental Europe, and the third one are the emerging economies, the BRICS nations. Now, the first Anglo-Saxon group, which comprises the US, the UK, Canada, and Australia. These countries are proponents of the free market. I mean, funnily enough, they're talking about free market. And the continental Europe is more divisive about, they want more regulations and governance for the international financial markets so that there's no repetition of what we have seen lately. And third one, that the BRICS nation, that is Brazil, Russia, India, and China, they are more worried about, because they don't have any say in these meetings. I mean, yesterday, the Brazilian finance minister mentioned that the emerging economies have no power. They are tired of meeting with the developed economies, and the only thing they are allowed to do is to drink coffee. So you can very well understand where the G20 is heading from here. And the second reason, which I think this will not be successful, is because US is being represented by President Bush, who will be out of the White House by 20th of January. So you have a scenario where the President-elect Obama may not agree with the policies and the focus which the present administration has. So I think it's a no-go.
Sandeep, a fair point. Prashant also joining in. There will be a lot of downgrades coming in, both on the growth forecast for India specifically and also on the earnings front. Do you expect more earnings shock in the December quarter or perhaps the March quarter, so as to speak? Is that going to happen, or you think it's already in the price?
I think from the earnings perspective, the street is still pricing in about 20% growth or so for corporate earnings. So in terms of the corporate profits, December quarter, as you mentioned, there will be a shock in the December quarter, and there will be a bigger shock in the March quarter. The recent deterioration in the jobs data, which we are seeing, that thousands of people are losing jobs across all sectors in our country, will start to show, the effects will start to emerge from about, say, 90 days from today. So to answer your question, I don't think it's fully priced, and to a certain extent, of course, the way we are seeing the erosion in stock prices. but it's not fully priced in, because I'm more worried about decline in profits rather than growth, and which market is still not talking about it.
Sandeep, you did say that the US is in a painful recession and we will see maybe a retest of the October 27th lows. In India as well, do you feel a scenario like that is possible, or we will at least maintain those lows?
The retest is very much plausible. We may go in for new lows. That also is a very doable scenario in my opinion. The thing is, the whole growth momentum is coming to a halt, and it's not helping that this in the next 6 months we'll be seeing elections now. So most of the measures that the government, the policies have been about in the last budget, and so far what we have seen have been very populist in nature. So I think we should be more worried about our domestic concerns, more on the fiscal deficit side. The macro issues are not really helping in any ways. So I think the slowdown can be quite dramatic. We can be looking at GDP at 5% or possibly lower. We need to be, everything boils down to what extent, how the rupee is going to behave. Now, if we have 8% fiscal deficit, if I'm taking into account the off-balance sheet, which the finance ministry does not take into account, we are talking about the farm subsidies, the farm waivers, the fertilizer subsidies, the oil bonds, and the new pay commission which has come about, increasing the salaries of the government employees. If you add all these up, it comes to about approximately 8% of the GDP. Now that's a gross fiscal indiscipline that we are talking about. So there's no surprise why rupee has depreciated in the recent past, and it may continue to depreciate from here. Because in the next 6 months, government may become even more populist in nature. So you're talking about depreciating rupee. In effect, we'll be importing inflation, and that will keep a lid on. That will be like a floor actually, not like on the interest rates. So we may continue to have higher interest rates, and that's where the growth gets hampered of our economy. That's the biggest concern that we should be looking at. So and clarity will only emerge after the elections about who comes into power.
You expect low rates of interest to help the cause, or you don't think that's going to do much? Because lower interest rates are always at least considered good for equities in any sort of an environment, and the government and the regulator here are very focused now not on inflation but to save growth, and thus hence lower rates of interest.
So sorry, it's not very clear, but just to reiterate, you're asking if we're going to see a lower rate of inflation?
No, I was trying to understand, Sandeep, if you expect lower rates of interest, lower interest rates to help the cause, to try and save some of the growth, slackening off that we were talking about.
Yeah, the interest rate cycle, if it turns, is extremely good for the economy. But the question is, how do we? It's a very tough task for our monetary policy decision makers. It's just lowering the interest rates may not help if the inflation doesn't come out, and if the rupee continues to depreciate, and government has a big borrowing program, because government will not be able to borrow money if the interest rates are any lower. So we need to bear that in mind. But if the scenario that you're saying, yes, that will be the best case for the equity markets if interest rates do start to come down.
So Sandeep, finally and quickly, I gather you're not buying in this market.
It's not that there are pockets of strength, but the levels that people will be comfortable at. Of course, you can be looking at companies which have a big amount of cash in their balance sheet. A lot of companies are trading below their book values. So there's opportunities in every kind of market, but I will not be gung-ho in terms of buying and saying that everything is over. I think it's anything but over.
All right, anything but over, and hopefully we'll get you on more analysis, Sandeep Bharadwaj, on a regular basis on ndtv Profit. It's been a pleasure speaking with you, Sandeep Bharadwaj, saying our GDP growth could test 5% or lower, and we could retest October lows globally as well as domestically.
The caveat for not achieving that 5% rate of growth is, of course, lower interest rates. That's also something you mentioned towards the end of our chat. We'll take a quick commercial break, come back with ICICI Securities of